When people say venture capital, they usually mean money for startups. But here's the thing. Not all startup money is venture capital. It's not crowdfunding. It's not your rich uncle cutting you a check. And it's not an angel investor writing a personal check because they like your idea. Venture capital is way more specific and much more powerful. So let's break it down. Basically, venture capital is a type of private equity, meaning ownership in companies whose shares aren't traded on the stock market. Here's the textbook definition. Venture capital is institutional private equity investment in high-growth startups. Three words matter here: institutional, private equity, and high growth. Let's unpack them. VCs are not just wealthy people tossing money around. They're professional investors managing other people's money, usually from massive institutions. Think pension funds, university endowments, insurance companies, even corporations. These big players take a tiny slice of their portfolios and put it into what's called alternative assets: real estate, hedge funds, private equity, and venture capital. In VC language, those institutions are limited partners, or LPs. VC firms run the fund, take a management fee, and earn a slice of the upside if things go well. And legally, they have a fiduciary duty. In plain English, they must act in the best interest of those LPs. Now, here's where it gets interesting. Angels versus VCs. Angels invest their own cash. Maybe it's a successful founder backing the next generation, or someone who just loves the idea. They don't have bosses. They don't have fiduciary duties. They can invest for any reason. VCs, on the other hand, answer to their LPs. So when you raise from venture capital, people call it your first round of institutional money. It's a stamp of credibility, because now you've got professional investors betting on you. Okay, so what are you actually giving up? When VCs invest, they're not lending you money. They're buying equity, usually newly created preferred shares. Here's why that matters. Unlike public stocks, these deals are private and illiquid. You can't just sell tomorrow. VCs don't just sit back. They usually take board seats, guide strategy, and actively push growth. And because this is equity, not debt, there are no repayments. Instead, founders and VCs are tied together until an exit, which usually means a sale of the company or an IPO. That's when everyone finally gets paid. And here's the kicker: high growth. Venture capital only works if a tiny handful of companies explode in value. Most portfolio companies fail. A few do fine. But one or two become unicorns, billion-dollar businesses that make up for everything else. That's why venture capital is a hit-driven business, kind of like the movie industry. One blockbuster covers all the flops. So VCs aren't looking for steady, slow-burning businesses. They're hunting rocket ships. Here's the bottom line. Venture capital is institutional money invested into high-growth startups in exchange for equity. It's expensive money. You're giving up ownership. But it also brings credibility, networks, and the fuel you need to scale fast. As a founder, you have to ask, do I want to grow steadily on my own? Or am I ready to take on venture money and aim for the moon? If this gave you clarity on what venture capital really means, check out my explainer on Safe Notes and grab my free cap table template in the description. And of course, hit subscribe for more startup explainers.